This is the end, my beautiful friend. Those are the words of Jim Morrison, but he had a rather dark outlook on life. However, it is the end. There is no way out for the world's central banks and for the monetary system the way it is currently designed, the global monetary system. This is the end, and it's going to be chaotic. But like I've always said, this could be the best thing that ever happened to you financially. You're just going to have to stick around to the end of this video because there are a couple of different outcomes, but all roads lead to the same destination. So in my video where I covered the website, WTF happened in 1971, there were some charts that I came across, and I made some promises to you that I would follow up on those charts because there was more behind those charts than I could cover in that video. It would have made that video an hour-long video. But here, when I got to this chart and I was talking about income distribution, this is the bottom 90% and the top 1%. The top 1% used to make more than the bottom 90, and then the bottom 90 made gains, the 1% had losses, and then it's come back up. And I don't know exactly where we are here in 2020, the way they're measuring this. This is the top 0.1%. I'm sorry, not the top 1%. But one of the things that I said was back here in the 50s, the income tax rates were above 90%. I said 94%. Well, actually, that was in 1944. I took a look into it a little bit more and refreshed my memory on that one. And the other charts that I said I would come back to is federal debt held by the public, and this is as a percentage of GDP. These are basically the same chart. This is just zoomed up on this area right here. And I wanted to come back to you because there's a lot behind these charts that you need to know. And all of this has to do with the outcome, where things are going and how it's going to affect you and how you could possibly benefit from it. But it's going to change the world a lot. Just like I showed you, if you didn't watch this whole video, you should watch the whole video. WTF happened in 1971 because down near the bottom you see that when we made the disconnection, when we severed the tie between money, the gold and silver that backed our currency, and the currency became backed by nothing but a promise to tax you and me in the future, when it became backed by treasury bonds, which are debt where the government collects taxes in the future to pay that debt. That was the point where everything changed, and it changed our lives. It changed the world a lot. There was a certain trajectory we were on before that, and the trajectory changed radically after that. And you'll see that if you watch that video. WTF happened in 1971. But in that video, I inserted a piece from an old presentation that I gave back in, it was July or August of 2018, called Early Warning. And it was early, but it was a warning about what is happening right now. Everything that is happening was destined to happen. It may have been able to go on until later this year or something before the bubbles start to burst. The pandemic turned out to be the pin, but our economy was basically a bug in search of a windshield. We have bubbles in search of pins. The pandemic happened to be the pin. But the economic consequences, though they're going to be made a lot worse because of the lockdowns and everything else, the economic consequences were destined to be. And one thing I pointed out, I showed a very long-term chart that was in WTF happened in 1971 of interest rates going back 3,000 years. And you saw that there was a cycle to them of low interest rates, high interest rates, low interest rates, high interest rates, low interest rates, high interest rates. It's just a wave that goes throughout time. But when you pick the minimums, the lowest interest rate in a period in one of those cycles, it turned out that the highest interest rate was almost exactly in the center, within a month or two of the exact center of those two low interest rates. And taking that same theory and applying it to today's cycle, this data ends in, I believe, July of 2018 here. And so now we're out here, but the interest rates have come down further. But they should reverse sometime between 2021 and 2023, unless the Federal Reserve tries to keep them from reversing. I'm going to show you why they would do that, and I'm going to show you what the outcomes are either way. So getting back to the presentation, this was WTF happened in 1971, and I'm going to expand on this gross federal debt. And one of the things they were showing was held by the public. That's the part to remember. So these are Treasury bonds, bills, and notes that are being held by the public. They use this term very loosely. This is a document, Budget for a Better America. It starts off with a letter, a message from the president to the Congress of the United States. But later down at the very, this is like 80% just commentary. It's page after page of words. And then you get down to the very bottom and there's some tables down there. And the very last page of all the tables, page 143 out of 150 of the PDF, it's, if anybody's interested, it's page 139 of the document. But what we've got here is debt held by government accounts. I'll show you that in a little while. And this is the debt held by the public. And then there's this little footnote. It says 6 right there. And so these numbers, the projections are quite inaccurate. They're always projecting things low. Another thing that I find to be sort of hilarious always is every administration does this. They show the debt as a percentage of GDP increasing under their reign. And then once they're out of office, it's supposed to decrease, and we're going to get back to a balanced budget one day. And they always show this. But down here, if you look at that footnote, note 6, at the end of 2018, the Federal Reserve banks held $2.3 trillion. This is 2,000 billion. So $2.3 trillion of federal securities and the rest of the public. I had no idea that the Federal Reserve was part of the public. But according to all of this accounting, it is. The Federal Reserve is part of all of us. Did you know that? Did you know that the Federal Reserve is like your neighbor, your friend? So we held 13.4 trillion and they held 2.3. Well, that 2.3, as I'll show you in a minute, has gone up to 4 trillion since this was published. So here it is. This is assets, securities held outright. These are U.S. Treasury securities, and all of them, bills, notes, and bonds. And they come out with the level every Wednesday. And so what you see here is that before the crisis, we were at about 0.8 trillion, almost 800 billion, not quite. And then they gave a bunch of those to banks and swapped them for much more risky assets during the global financial crisis to keep a bunch of banks from going under. And then we have QE1, and this is QE1, QE2, QE3. And then they've got quantitative tightening, QT. And then the crisis that we are in actually started in September of 2019. And they started responding to some emergency by counterfeiting, typing currency into existence and buying treasuries, pushing more currency into the system. And then, as of March, we locked down the economy. They came out with all these emergency measures and bailouts and so on, and it's going crazy, and we're over 4 trillion. So this, again, is what the Federal Reserve owns of the public debt, that chart of debt held by the public divided by gross domestic product. The Federal Reserve owns 4 trillion of that debt held by the public. This is the total assets of the Fed that includes mortgage-backed securities and a bunch of other different types of assets, not just the bonds. And it's getting close. It'll pass 7 trillion very shortly. before the financial crisis, it was at about 0.9 trillion, less than a trillion. It's about to surpass 7 trillion. And you can see that their balance sheet was down to 3.75 trillion back in September, and now it's going to be close to 7. So within a few months from now, it will have doubled since last September. Pretty scary thought, actually. And I'm going to show you in a little while how all of these relate. So this is the federal debt held by the public. Remember that the Federal Reserve, their debt is the bonds that they hold is considered part of the public debt. So the bonds that they bought by typing currency into existence. So this is their debt, and before the crisis of 2008, this is all debt held by the public. It was at a little over 5 trillion. And then since the crisis of 2008, here we're over 7. So there's 12 trillion that it's increased since the crisis of 2008. Then we go to federal debt, total public debt. And this is the one I always get it cracks me up. Federal debt, public debt, please make up your mind. They can't. And then I sort of got it. Oh, federal, they're the ones that get to create the debt by spending what we don't have. And the public are the ones that become indebted and have to pay it back. Except remember, Federal Reserve doesn't have to pay it back. It's you and I that have to. Everything that the Fed has are treasury bonds that they bought through counterfeiting. It didn't cost them a dime. It's just keystrokes, and they own those treasuries. You and I have to pay those. Those are part of this public debt, and we have to pay it back through future taxation. That's our debt that we're all in. This is federal debt held by agencies and trusts. So if you go back here to debt held by the public, that's at 7. We're going to round this to 17.2 trillion, right? And then you go to total public debt, and this is 23.2. So from 17 to 23 is 6 trillion. And this is 6 trillion. So this is what was missing, is federal debt held by agencies and trusts. What agencies and trusts are these? These are federal agencies and trusts. The trust they're talking about is the Social Security Trust Fund. And there's a few other trusts for black lung disease for coal miners. There's trusts for railroad workers and other agencies. And anything that is part of the U.S. government that had an account that had currency in it, if there were dollars there, the Treasury creates a special Treasury bill, bond, or note, and takes the cash and adds it to the general fund and spends it and leaves IOUs in its place. And almost half of this is Social Security. I can't remember what the exact number is right now. It might be half of this 6 trillion. It might be 2 trillion. I can't remember. But it's in the multiple trillions. And what's interesting is the Social Security Trust Fund now, which was supposed to be our savings account to retire on, and it's full of IOUs. But the government doesn't think it counts because we owe it to ourselves. So we're all going to be able to retire on those IOUs that they left us with. Just try and go into the grocery store and buy food with an IOU from the government and see if it works. But anyway, so Social Security is having more outflows than inflows now because of the retirement of the baby boomers. So they're having to steal from other portions of the government more, and you're going to see some signs of that later. This is the chart that you saw on WTF happened in 1971 was the federal debt held by the public as a percentage of gross domestic product. And this doesn't look that worrisome. You know, you've got this peak. We were up at 106% back in 1946. And we recovered from that. We grew the economy much, much faster than the politicians were able to spend us into a pit of debt. Then we started digging the pit deeper, faster than the economy could grow. And then, so this is federal debt held by the public again. 78. It looks like we've got some headroom. We can do a bunch of deficit spending. We'll be okay. But then, if you take a look at gross federal debt, all the federal debt, including that debt that we owe ourselves, which we do have to pay back because you can't buy food with the IOUs that are in Social Security. They have to give you dollars. So we either have to, the Federal Reserve either has to type those dollars into existence, or they have to tax all of us in the future. And by the way, when they did the act back in the 80s to allow the Treasury to create these special bonds to steal all of the cash that was in any government account, when they did that act, that same act made Social Security benefits taxable, and the benefits are your taxes being returned to you that they're then going to tax. So this is all of the debt, including the intragovernmental transfers. That's that debt that's in the trusts and agencies of the federal government as a percentage of gross domestic product. And it was at 106% on the debt held by the public. It's 119 at the World War II peak here when you include all other forms of debt that the government has. But what I want you to look at here is the relationship between this peak here and where we are here at, this was at, we'll round it, we'll say 106 because it's definitely way over that now. This is annual data. So this is the end of 2019, and the 2019 fiscal year ends on the last day of September. And so you're talking about September 2019. So here we are a year and a half later, roughly, a little more than that. I think, I don't know, can't do the math in my head that fast, sorry. But watch the difference between the level of this peak and the World War II peak when I go back and forth between debt held by the public. It looks like we've got a lot more headroom, that they can do a lot more deficit spending before we start getting into trouble. But we've got a lot less headroom than that WTF happened in 1971 website was showing. Then we get to the federal debt held by the agencies and trusts as a percentage of gross domestic product. And as you can see here, they're not able, they were stealing at a certain rate, and this is where, they passed this, I can't remember whether it was in 81 or maybe it was like 1983 that they passed this bill. They did this study that was just a bunch of baloney. They did a study in a year that Social Security had more than $500 million surplus, so it was going up. And they said, if we don't do something about Social Security, it's going to be broke in a year. And they passed this. This was right after the Kemp-Roth tax cuts that Reagan passed. So the first thing was pass the tax cuts. Now the deficits explode. To offset the deficits, they said, well, what we're going to do, Social Security is going to be broke. That's a savings account for you. We've got to do something about it. Social Security is good. Income taxes are bad. So we're going to lower income taxes, but we're going to raise your Social Security tax because it's a savings account for you. And then the following year, they make it legal for them to replace the cash in the Social Security Trust Fund with IOUs. So they're just taxing you anyway. But you can see the angle that it was growing at. And then after the crisis of 2008, and the baby boomers starting to retire and drawing on this trust fund so that there's more outflows than inflows, this starts to decline as a percentage of GDP. So that decline is something, they don't want that to happen. It's forced, and it's part of this whole system starting to freeze up. Part of what I'm getting to in this video, the real point of where we're headed and the different roads we could take to get there. This is federal debt held by foreign and international investors. Investors. This is a term that is used very loosely. If you can call China an investor, because China owns, I forgot, it's at least $1 trillion of this $6.7 trillion. So this is almost $7 trillion of the $23 trillion. So you're talking almost a third. This is, I didn't do the math, but it's probably more than 28%, less than 30, I don't know. But it's a large portion of the country that foreigners have a claim against. You have to look at, this, we have mortgaged the United States. And the mortgage holders, almost a third of those mortgage holders, are foreign governments and foreign investors. This is the effective federal funds rate. So we're starting to get to the point of all of this. And I've taken it back to 1954 here. And what you see are, ever since the inception of the Federal Reserve, we've had these crazy rates. 0.25 back in 54, 0.13, so basically 0.1% in 58. And then there was a day, this is a daily chart. Most people won't show you this, but there was a day in 1980 where it was 22%. Now, something that's going to have an impact on the conclusion of this video is that the chairman of the Federal Reserve back in this area was Paul Volcker. And these interest rates here were below the rate of inflation. And when you have interest rates below the rate of inflation, it causes banks to do more and more lending and expand the currency supply. It's very inflationary if the interest rates are below inflation. And to stop inflation, he had to raise interest rates up to 22% on a day in 1980. So what they were trying to do, gold was in a runaway. This is over on this peak, that's March. It was January 1980. So we're talking 15-16% Fed funds rate. They were trying to get ahead of the double-digit inflation and make it more attractive for people to buy a bond than buy gold. This was really important because gold was in a runaway. It was going to go to the moon unless Paul Volcker got interest rates got interest rates on a really safe investment, and U.S. Treasuries have been considered one of the safe havens. He had to get them above the rate of inflation because back here they were called certificates of confiscation because they confiscated your wealth. You put $100,000 in bonds back then. Inflation would make that $100,000 the same amount of goods and services that $100,000 could purchase required $200,000 in 10 years to purchase the same number of goods and services, but the rate you were getting paid on the bond, you only ended up with $150,000. So you were basically losing a bunch of your purchasing power by investing in U.S. Treasuries. It was a bad investment, certificates of confiscation. So we're going to, and I just want to point out that this is insane. This can't happen. There's a day here you're seeing 0.9%. There's a day at 0.4 in here somewhere. I found it before. It's too much work to find it now. 0.7. But these are insane rates that aren't possible in a free market. We don't have free markets. Then just realize that these went up, and at the end of 2019, they were already coming down, and so we were at 1.55, and now they're down at 0.05, 1/2 of 1/10 of a percent, right? Is that what that is? 1/20 of a percent? It's unbelievable, the world we live in. And then this is federal outlays, and this is the interest that is due on the debt. And this is really important. We're starting to get to the point of the end of this video. And you'll remember that chart that I showed you with the interest rate cycles and the minimums, and there was an arrow balanced like a seesaw or a teeter-totter, depending, and interest rates eventually reverse. Now, the Federal Reserve can step in and hold interest rates low, but that requires a certain type of action. We'll get to that in a minute. But here's the scary thing. Interest rates went down to nothing during this time period, and they've been rising 2016, 2017, 2018, 2019. And this has to be paid out of the budget. And so it's the higher this goes, the more it squeezes out other stuff. Now, this is only a little over $1/3 trillion at this point. And, their budget was $3 trillion. It's going to end up being $5 trillion or $10 trillion. Who knows how much they're going to end up spending by the end of this year. But I know it's going, they're planning on selling in this quarter that we're in right now, third quarter of this fiscal year. They're planning on selling another $3 trillion in Treasury bonds to support all of this stimulus that they're planning. And so just keep in mind that this is rising, that interest rates are already about as low as they can take them, and there's consequences to negative interest rates that are bad and create a very unstable, fragile banking system. Negative interest rates are impossible in a free market. It's economically impossible, except in this crazy nightmare world that Keynesians live in. So I'm going to move on to something else here, 10-year constant maturity. So this is the interest rates on the 10-year note. And for 10 years, people are loaning their currency to the government and asking for a return of 0.7%. I skipped a couple of things that I need to go back to here accidentally. This is the financial report of the United States government from the U.S. Treasury. I much prefer the version from the Government Accountability Office. It's the same report, but it's got 10 pages added to the beginning of it that are addressed to the President, the Senate, and the House of Representatives. And it says things like that to operate effectively and efficiently as possible, Congress and the administration and federal managers must have ready access to reliable and complete financial and performance information. And then it says down here that certain material weaknesses in internal control over financial reporting and other limitations resulted in conditions that prevented us from expressing an opinion. They can't give an opinion on this consolidated financial statement because their accounting is so screwed up. The government accounting is so screwed up that the Government Accountability Office, the office that audits the Treasury and the rest of the government, the Congressional Budget Office, the CBO, and the Treasury, they are saying that this is so screwed up that they can't give an opinion on it. They say that progress has been made, but it also underscores that much work remains to improve federal financial management, and the federal government continues to face an unsustainable long-term fiscal path. Well, guess what? I used to download these every year until I became tired of it in like 2012. But the first one I downloaded was 2003, and this wording hasn't changed since then. It may have changed a tiny little bit, but it's basically the exact same as it's basically the same as it was back then. But I want to scroll down so you'll see that this is the same report with their 10-page letter attached to the front of it. And then I want to go to, they've got a table here that's a snapshot of the current, here it is, the nation by the numbers, and a snapshot of the government's financial position and condition. So they've got 2018 and 2019. We don't have 2020 numbers and won't have until after our fiscal year. but they've got net costs, net operating costs, budget, assets, and those are loans, property, plant, equipment, other. So total assets comes to $4 trillion. We're going to round that. $3.99 billion, $4 trillion. Less liabilities comprised of debt held by the public and accrued interest. And so that's the federal debt held by the public. Then they've got federal employees and veterans benefits of $8.5 trillion. Did you see that in any of the other places of that isn't Social Security. That's not the other things that were in the intergovernmental transfers. This is federal employees and VA benefits that we owe $8.5 trillion of as a liability, and it wasn't accounted for anywhere in those Federal Reserve charts or anywhere else that we've seen it. So you've got total liabilities of $27 trillion again, and our net position then, when you deduct the $4 trillion, you come out at $23 trillion upside down. So the government is essentially bankrupt and in the hole by $4 trillion. We are completely upside down by that amount, according to this report. But there are others, which I'll show you in a minute. So this, I believe, because there's a footnote here that says to prevent the debt to GDP from rising over the next 75 years, a combination of so 75 years. I believe these numbers, if you notice, this is measured in the trillions. This one was measured in the billions. So we're talking about almost $60 trillion Social Security expenditures, almost $50 trillion non-interest net expenditures. And so this is some of the unfunded liabilities that they're referring to here, where we've said, we're going to give you this. We have no idea how we're going to pay for it, but we're going to give it to you in the future. Moving on to, this is the same report again. I don't need to go through this. I'm just going to close that tab. I guess I had all of these open to different pages, and I closed my browser and reloaded it. So I'm not, so here's the Secretary of the Treasury. Nice picture. And then we get a completely different accounting. This one shows that instead of being $4 trillion underwater, the Treasury's accounting in this report shows that we're worth $500 billion, but still the claims against the United States. Remember, there was $7 trillion of foreign claims against the United States, and we're only worth $500 billion. We're bankrupt. Here we go. So this is page 32 of the document. It's got total assets of $25.6 trillion instead of $4 trillion, total liabilities of $25.125 trillion as of 2019. How do they get these liabilities? Because if you look at 2019, this is more than $2 trillion. There's $2 trillion missing from the national debt in 2019 that is part of these liabilities, and I have no idea where that is. But this basically says we're worth $500 billion, our total net position of the U.S. government. This is our net the federal outlays as a percentage of gross domestic product. So what we're talking about is how much the government spends. Forget about the budget that they create. What do they spend by the end of the year? And what you see here is that, back in 1929, they were spending 2.99% of GDP. The federal government spent 2.99% of GDP on us. And we just had the roaring 20s with them spending less than 3% on us. And then even during the Great Depression, we're talking about 8.5% roughly, the average during that. Then we get to World War II, and it goes up to 40% of GDP. So we're doing huge deficit spending here. And then we get to the point, remember, I said that we'll get to the taxes in just a moment, but the top marginal tax rates in this period where they're spending about probably 16 average or 17 let's say 17% of GDP up until the mid 70s, and then it jumps up to roughly 20%. There's a little dip here during the stock market boom of the late 90s. But then it settles back in on 20%. So you could just sort of average this from the mid 70s at 20% and before the mid 70s at about 17.5%. And then you take a look at the federal government's income. So these are the receipts as a percentage of gross domestic product. And remember, they're spending 20% here, but the income is 16%, 17%, 19% during the years when we had the big stock market boom, the internet, the tech bubble. But we can say that these years here average 17.5%, and we can say that these years here average about 16%. This is 15% and 17.5%. So about 16% across. So this century is 16%. The 90s, the 80s, and the 70s at about 17.5%. And then about 16.5% into the 50s. And in 1929, the government took in 3.7% of GDP, but they spent 2.99%. So they spent 3%. So there was a surplus in 1929. But even during the Great Depression, they were running deficits, but they're taking not even 5% in those early years. And then it went up. This is the Roosevelt recession, it's called, and then World War II. Now, why is all that important? Here is the highest marginal tax rates and the lowest marginal tax rates. In 1944, it hit 94%. So anybody making enough only got to keep 6 pennies for every dollar that they made. Notice that these go from zero down here in 2012. 2013 is when the income tax was made legal in the United States once again. They had had a couple of periods of time where they had income tax. They did it during the Civil War. There was another income tax between the wars. But then they did away with it, and there was a federal court decision that made it difficult for the government to do this. And that was resolved in 1913 with the passage of the 16th Amendment, making it legal. And in 1913, the tax brackets were 1, 2, 3, 4, 5, 6, and 7%. And to qualify just for the 1%, you had to make a lot of currency. To qualify for the top tax bracket of 10%, you had to make the equivalent of like 20 or what would be $20-30 million today. Or maybe it's, I haven't done, I need to go back and do the inflation-adjusted figures. But it may be over that. It may be more like $100 million that you had to earn to qualify for 7% income tax. That's how they got this thing passed. And then just a few years later, look at what they do. We did have World War I in here, and it left us very indebted, and the Federal Reserve issued a lot of bonds. So that got us to this increasing tax on the national debt. And the last chart here being, the interest rates will reverse. If you remember that chart with the interest rates going up and down and up and down, each cycle, it's sometime between 2021 and 2023, that cycle should want to reverse. It should be something that is that the market is forcing. And what forces it is if we go into inflation. Inflation can be very dangerous And to get a hold on inflation, like I showed you, what Paul Volcker had to do was raise interest rates until they were above the rate of inflation. And that's how he stopped inflation. And then we had something called disinflation, lower levels of inflation, not deflation. Deflation is when there's actual contraction, but disinflation is less inflation each year. Year over year, there's less than there was last year. Deflation is actually contraction in the economy, a contraction in the currency supply, a contraction in prices. And so we're down here below 0.7% on a 10-year treasury. And this will reverse. And now for the point of this very long presentation. I know this was a long way to get here, but this is from the Federal Reserve Bank of Chicago. So this is official Fed language here. Now, some of it is a little hard to figure out. Some of it I haven't even figured out yet. But you've got to know when they say monetary policy is Federal Reserve and currency creation and the banking system. Fiscal policy is the government. That's the deficit spending, and that's all of the government projects, and that's so that's fiscal policy. Is they're going to give encourage this by giving it a tax break. They're going to tax us here, and they're going to give it to those companies or whatever. So fiscal is government, monetary is Federal Reserve. So the COVID-19 pandemic found policymakers facing constraints on their ability to react to an exceptionally negative large negative shock. The current low interest rate environment limits the tools the central bank, so that's monetary policy, can use to stabilize the economy, while the large public debt, the national debt, curtails the efficacy, the ability for it to have anything that they do to have an effect of fiscal interventions. So the efficacy of the government's stimulus measures and everything else by inducing expectations of costly fiscal adjustments. I don't really know what they're saying there. Against this background, we study the implications of a coordinated fiscal government spending and monetary, the Federal Reserve creating currency for the government to spend, strategy. So it's the Federal Reserve is supposed to be separate. They're supposed to they've got a directive to keep inflation, target inflation, and to target certain unemployment levels. And so that's what they're supposed to do. Stable prices and low unemployment is like their mandate. And what they're talking about here is coordinated with the government fiscal and monetary strategy aimed at creating a controlled rise of inflation. And that is to wear away a targeted fraction of debt. So they're going to try to inflate away the debt, meaning creating a whole bunch of currency. And so they want to pay back the debt that they're creating now with cheaper dollars. And hopefully everybody will be making more currency, except there's something called the Cantillon Effect that we've talked about before. Whenever they create new currency, that purchasing power is stolen from all the other units of currency and bestowed upon the individual that gets to spend that new currency first into circulation. They're receiving stolen property. It is theft, and it is fraud, and it is enslavement because it steals from one group to give to another. Under this controlled strategy, the fiscal authority, the government, the Congress creating all of their plans and deficit spending, the fiscal authorities introduce an emergency budget with no provisions on how it will be balanced. In other words, how they will pay for it. No provisions on how to pay for it. While the monetary authority, the Federal Reserve, and this will happen with all of the world's other central banks, if we go down this road, everybody else will also, tolerates a temporary increase in inflation to accommodate the emergency budget. So they're going to We're in that deflation right now. We're going to be headed into inflation. Maybe by the end of this year, we're going to start seeing big inflation coming at us. So a temporary increase in inflation to accommodate the emergency budget. In their model, how well have their models worked out so far? I want to ask everybody that. Just how well have they done so far? The coordinated strategy enhances the efficacy, the ability of the fiscal stimulus to have some sort of effect, planned in response to the COVID-19 pandemic, and allows the Federal Reserve to correct a prolonged period of below-target inflation. They've been trying to target inflation at 2%. They used to say between 3 and 4% was proper inflation. Then when they couldn't reach 2%, they said 2% is proper inflation. We've got to get there, and they just never were able to hold it there at 2%. This strategy results in this one. Wait until you hear this sentence. The strategy results in only moderate levels of inflation by separating long-run fiscal sustainability from short-run policy intervention. I don't know what that means. Maybe you guys can figure out, try and decode this. I'm pretty good at decoding this stuff, but somebody can leave it in the comments below. But we're headed for inflation. Watch episode 7 of Hidden Secrets of Money. The inflation that they create will ultimately come back to haunt them if they try to get the inflation under control. So this is the point of the video. This is the end game. There's a couple of roads they can choose here, but those roads lead to the same destination. Remember this chart where we're already seeing the interest on the federal debt rising, and this is during super low interest rate environments, and it's going up because of the quantity of debt. Now they're going to increase that quantity, and believe me, it was at 25 trillion on the national debt clock. We're at 20, just a couple of weeks ago, this was at like 24.7. And I said it'll be at 25 soon. We're already nearing 25.2. And this doesn't include the 3 trillion that they're borrowing this quarter. By the end of 2020, this will exceed 30, but it could exceed 40 or 50 or even 100. Go out 2 years from now. Could this be over 100 trillion? 200 trillion? Where do they stop? And by the way, if this works, why hasn't it worked so far? If it works, why can't they just print $1 billion for each of us and just give it to us? This does not work, and they keep on proving it. Japan has proven this since 1989. Year after year after year, Japan proves that Keynesian economics doesn't work. Yeah, we're doubling down on it. It's just unbelievable. But getting back to the interest rate cycle and interest rates going up, I want to take you back now to the interest rate cycle. And in that long-term graph that you saw in WTF happened in 1979, you saw that there was sort of a cycle to this going back in time. And that was interest rates going back for 3,000 years. And there was this low spot here and a low spot there. And I picked this as a single cycle of low to high to low. And it turned out it was almost exactly the same number of months from one side to the other. And that's sort of what we see in the other cycles. And if you apply the same thing to that low and go out into the future, the next low should be 2021, 2022. Sometime or another, interest rates are going to want to reverse. If they reverse and go up, then the interest that the government pays gobbles up all of the available funds for their budget, and they've got to do deficits just to do the things like be able to pay Social Security and all of those other things that they've promised. There's certain discretionary spending, and then there's mandatory spending. And the mandatory spending will be completely gobbled up by interest, so they're going to have to do deficit spending, not for the stuff they want to spend, but for the stuff they have to spend. The only way to get the inflation under control is to raise interest rates. And so if they raise interest rates, that even though we're borrowing more, if they raise those interest rates and this goes up like it should naturally, then they're in this hole where they have to keep on printing more currency and have larger and larger deficits going forward. If they keep them low, you end up with runaway inflation because of the bank's ability to create currency, and everybody eventually will start borrowing because it doesn't cost you anything to borrow. So they're damned if they do, damned if they don't. There's two paths that they can take here, two different directions, and all roads lead to hyperinflation. I want to thank you for watching, but please try to protect yourself. Find some safe haven assets that aren't U.S. Treasuries, and just try to protect yourself the best you can. I make no recommendations. You've already heard what I'm doing. I want to thank you for listening. We'll see you next time.